This is Debt Free in 30, where every week we talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
On today's show, we answer a simple question. How can you deal with Canada Revenue Agency when you have tax debts? Why is this an important question? Because taxes are a big issue for our clients. We know from our Joe Debtor study that 40% of our clients owe money on taxes when they file a consumer proposal or bankruptcy with Hoyes Michaelis. Of those 40% who owe taxes, they owe an average of just under $23,000 in taxes, and that represents about a third of their total debt. So why do people owe money on taxes, and what can be done about it? To answer those and many more questions, and to give us 10 tips for dealing with CRA and tax debts, I'm pleased to welcome back on the show our resident Hoyes Michaelis tax expert, Ian Martin. Ian, welcome back. How are you doing today?
Very good, Doug. How are you?
I am great. Thanks very much. You've been a guest a few times here on Debt Free in 30. About a year and a half ago, you were a guest on show number 84, and I'll put a link in the show notes to that show so that our listeners can go back and listen to that show. Today, I want to cover some new areas with you. But before I do, I'd like you to give our listeners the 30-second summary of your professional career. I know you've been with Hoyes Michaelis for the last 8 years. What did you do before that?
Well, even before that part, I mean, as a trustee at Hoyes Michaelis, obviously I talk to people who find themselves struggling with debt, so I'm very conversant with that part of it. But prior to that, I was an employee of the Canada Revenue Agency for almost 7 years. Yes.
Oh, boy.
Yeah, so I know you've teased me about that many times over the years, but it gives me knowledge and insight about how the tax man works. I understand about taxes more than the average person does. And even before that, I am a CA by trade. So I think really the combination of education and training over the years, it puts me, well, really over the last 20 years, it puts me in a good position to be conversant to help people manage their tax debts.
I rescued you from CRA is what you're saying there. So,
well, it was a joint effort.
There you go, joint effort. So I mentioned our Joe Debtor study where I said that 40% of our clients owe tax debt. So can you give us a quick overview of the kinds of taxes we see people deal with through either a bankruptcy or a consumer proposal? Right.
And there are a lot of different ways. I mean, the first and most obvious way is on your personal income taxes. And that can come from a variety of ways. So this would be, I file my personal tax return, I have some money on it. But something that a lot of people get confused on is somebody who has a small business where they're operating as a sole proprietor. So that means that they're not incorporated. So for that person, their business activity goes on their personal tax return. And even if it's a business, it is personal tax that they owe. That's the most common example. But then also for the sole proprietor, maybe like a contractor or a subcontractor, people often owe money on their GST or their HST account, and that can grow without them really realizing it. So that's another common example. I can think of two other common ones. People who have their own employees, there's requirements, just as you do for me. When you pay me every couple of weeks, Doug, you're required to.
I do. Got to give money to the government.
Yeah. So you're required as my employer to withhold a certain amount for different statutory obligations. You remit that on my behalf. So then we often see people who things get tight and they either don't fully understand that obligation or they fall behind on paying that money for their employees. And another common example, so there's a couple things there that are related to businesses, but as somebody as a sole proprietor, so not incorporated. But then there's another part that is a little bit unique where somebody they operate their business through a corporation. Sometimes people don't realize that even for the corporate accounts, say like the corporate HST account or the corporate payroll account, they can be reassessed personally by the Canada Revenue Agency in their capacity as the director. So oftentimes people will incorporate to protect themselves from certain debts, but there are some, such as a corporate payroll or HST account, that can basically pierce right through that and come after you personally as well.
Yeah, so there's a lot of different ways you can end up owing taxes, and obviously unpaid income taxes being the most common one. And you talked about people who are self-employed or who owned a business, which is not incorporated. That's the same thing as being self-employed. So when we look at our numbers, about 9% of our clients are self-employed at the time they file their consumer proposal or bankruptcy, and many of them were self-employed prior to that and then ended up getting a regular job and had to file bankruptcy. And of those that are self-employed, about 2/3 have unpaid taxes. So it's a very common issue for someone who's self-employed. On average, those tax debtors owe almost $52,000 to CRA, and their tax liability makes up almost half, about 46% of their total debt. So my question for you, Ian, is why is it so common for someone who is self-employed to find themselves so deep in debt with Revenue Canada.
Right. And that is, it's really a variety of factors, but then also, I think you've said it, it's also a very common scenario that we see.
Well, give me a scenario.
Exactly. So here's a typical scenario. Somebody who, we see a lot of people work in different, let's say, construction subtrades within the housing industry. We see a lot of people who are drywallers, framers, roofers, where they're not employees. So we're saying a little while ago, you, as an employee of yours, you're required to withhold certain amounts. So if you're a self-employed subcontractor, there's nobody who is withholding tax amounts and paying it to the Canada Revenue Agency on your behalf. So I see a lot of subcontractors who, number one, don't realize that. They don't realize that, or maybe they didn't realize it at the start. And so maybe they fell behind for a couple of years. But then in the meantime, life today for the typical person, it's pretty expensive. So imagine, a common example, like a young guy who maybe gets into, say, the roofing industry, and he's trying to pay his bills, but maybe he's got a couple credit cards. He's getting that credit card statement every month. It's showing him the high interest. So if he had to prioritize, he pays that. So with the taxes in the Canada Revenue Agency, it's the kind of thing where it can kind of creep up on you slowly over time, where they don't send you a bill monthly. If you don't file your taxes for 1 year, it's not like they're right on you. Sometimes it can take many years before people really realize or they perceive how bad it really is.
Yeah, and if you were an employee before and never had to worry about taxes, and now all of a sudden, like you say, you're not getting a statement every month, you kind of forget that there is this liability building up, and then finally you get the taxes filed and it ends up being a huge number. Well, we know that according to Statistics Canada, there were 2.8 million people who were self-employed workers in Canada in 2016. So obviously, it's easier administratively to be an employee because your employer, like you said, takes an amount for your taxes right off your paycheck and then sends it to CRA for you. When you're self-employed, you're responsible for making those payments yourself. So in your experience, why would anyone go through the hassle of being self-employed? It's obviously easier to be an employee. Why go through the hassle of being self-employed?
Right, and even there, like all things, there's a variety of considerations. Some people, they want to be their own boss, right? They don't want to work for somebody else. They feel empowered to not be answerable to somebody else. But it brings with it certain risks. And so I guess in that way, you're saying it's a choice. It's a choice. But a lot of the scenarios we see, like the scenario I was saying a while ago with people within construction subtrades, often it's not by choice. Often there's a lot of situations where people, for all intents and purposes, probably should be treated as an employee and take away some of that risk with taxes and HST and also WSIB as well. But the way the industry is set up is that the company doesn't want to do that. So if you want to work, then you have to be a subcontractor. But then there's lots of other people as well where, again, it's not by choice. Like maybe somebody's been working at a factory for years and years and years, and it shut down. It got laid off. And they're looking for some other job opportunity that's just not there. Even though it's probably not the optimal time, some people do see that as the chance to be their own boss, to try something different because there weren't a lot of other appealing choices at the time.
Yeah, and you're right. There's a lot of industries where you don't have any choice. I mean, a lot of truck drivers, for example. Hey, you want to be a truck driver? You got to have your own truck or lease your own truck. You're self-employed. That's just the way it is. So.
And what that's doing, it's downloading a lot of the administration, a lot of the costs, and a lot of the risk from the big company down to the individual who maybe isn't properly equipped to handle all those challenges.
Yeah, I mean, your employer kicks in for CPP. When you're self-employed, you're paying your portion and their portion, as well as doing all the administrative stuff. So yeah, it's a big issue. Now, I don't want to make this all about self-employed because not everyone who owes money to CRA is self-employed. What else would give rise to someone owing money to Revenue Canada other than being self-employed?
Right, and there's you say that, and I think of two common scenarios right away. And even generally speaking, when I meet with somebody who has tax issues, this is a big part of what I like to explore. And whether it's from being self-employed or from the other reasons we'll talk about in a second. And for me, that's really, really important so that people identify that and are able to make some changes going forward. So in answer to your question, Doug, sometimes the way of the world today, especially younger generation, a lot of people are finding a challenge finding full-time permanent work. Maybe they're able to kind of piece together or cobble together a couple different jobs in trying to secure full-time hours. The risk with that, so even if you're an employee now, right? Again, you're an employee, say 2 different places, each employer is required by law to withhold certain amounts, but maybe the second job, the smaller hours, maybe they're not aware of the first job, and maybe they're following all the rules properly, but they don't take enough tax off. So when you do your tax return at the end of the year, the amount of tax that you're required to pay is based on your total income for the year. So basically, maybe there wasn't enough tax coming off the second job. That's a very, very common scenario.
Yeah, you got two jobs. They both think you're in the 20% tax bracket, so they're taking 20% off. But when you add them together, you're in the 30% tax bracket. They didn't take enough off. You end up owing more.
Yeah, or even more so. Sometimes people have like a very small second job that might not be very much money at all. They think it's not a big deal. But if the income is low enough, maybe that second employer isn't taking any tax off at all.
But when you add it to the first one, you got to pay tax at your total rate. So, there's lots of reasons why people would get into it. And we see that same scenario with people on a pension too.
Yeah, that's exactly what I was going to say. It's very similar. Like when you maybe people have multiple pensions, maybe they're still working a part-time job, and especially when money gets tight. If life is expensive, maybe they have some other debts like a credit card or line of credit they're trying to pay. It's really hard to volunteer, even if you recognize the issue is that there's not enough tax coming off. We call that being taken off at source. It's really hard to make that decision to voluntarily have somebody take extra tax off when in the here and now you're struggling.
I need that money.
I know I'm going to throw out another scenario that we've talked about many times before. And this is where, again, people that we see all the time, every day, where they're struggling with their debt payments and they look at the investments they've accumulated over time. They look at something like their RRSP. And so it's not a great decision, but it's understandable that people will start pulling money out of their RRSP, trying to keep up with their minimum payments. But right there again, you've got another source of income that is taxable in the year you take it out. And there's legal minimums that the different, the bank or the insurance, basically where the investment is held, there's restrictions or regulations on how much the minimum taxes they're supposed to take out. But that's where, similar to a second job, in hindsight, it wasn't enough tax.
Yeah, so if I take $3,000 out of my RSP, they're going to take 10%
right,
tax
10%,
off.
$300.
And if I did that every week or every month, at the end of the year, I've taken out $30,000 or $50,000 or whatever, they should have been taking off 20, 30, 40, 50%.
Correct. Right. So that extra 20 or 30% that didn't get taken off right away, it's at the end of the year, you get that bill. But again, like we were saying before, for somebody who is pulling that money out, trying to keep up with their monthly payments, even if they understand what we've just talked about, it's really hard to make that conscious decision to have the bank take off more tax because you feel like you need it right now.
Which is why you're taking the money out. So lots of different ways you can get into trouble with Revenue Canada. So I want to spend the rest of the show giving practical advice. You've been a professional accountant for 20 years. You've worked for a big accounting firm. You spent a few years at CRA, and now you're a licensed insolvency trustee with Hoyes Michaelis. So let's give our listeners a bunch of practical tips they can use to deal with taxes. Now, I ask most of my guests for one practical tip at the end of the show, but from you, I want 10 practical tips.
It's a lot of pressure.
A lot of pressure on dealing with CRA and avoiding tax problems and dealing with tax debts if they happen. So I'm going to throw some stuff out here, and I want you to tell me what you think.
Sure.
So tip number one, I think the most obvious tip, and I could think of this one myself, is file your taxes on time. So why does that matter? Either if I'm owing money or getting a refund. Why does it matter to get them filed on time?
Right. So, and I want to make sure we're clear on the wording here. So when you file your tax return, like the tax return is the information. It's a document that you file to the government that says, here's my summary from last year. And then from that, there's calculated either a refund, meaning that they're going to give you some money back, or you have a balance owing saying, I've got more I need to pay. So in the situation of having a balance owing, if it's not filed on time or the amount owing isn't paid by the April 30th deadline, there's penalties, right? There's an automatic penalty for late filing, and interest starts to accrue right away based on that date.
So there's two different things, penalties and interest.
Correct. Two different things, right? There's like a one-time hit. I'm drawing a blank on the amount, but there's a one-time hit, but then you keep accruing every month until that amount is paid. So that can grow significantly over time. We've seen lots of examples of people who it kind of festers in the background for years and years and years. They show us their tax bill of $50,000, and almost half of it is penalties and interest.
It can easily double the amount. So if you don't get your taxes filed on time, you get hit with a penalty. If you owe money, you're also paying interest on that.
Right.
On that, and of course, if you're getting a refund, you're not getting a refund if you don't file your taxes.
Right, exactly. So if you do have a refund, file it so you can get, they're giving you your money back. So you might as well do that, and that can help with all sorts of different things. But also the tax man's not going to pay you interest. They'll charge you interest if you owe the tax man, but they're not going to give you interest.
They charge you interest if you owe them, but if it's a refund, too bad, you didn't file on time,
Right.
we're not giving you interest. So it's the double whammy. So, okay, so tip number 2 then, if I don't expect to owe taxes, is there any point in filing them?
Right, and I see that on a regular basis as well. People
I'm not getting charged a penalty for not filing if
exactly.
I don't owe.
Right, and that's where fundamentally some people will say, well, I know I always get a refund. I'm going to get around to it. I mean, yes, sure, I can get my little bit of money, but I
got to pay H&R Block $50
exactly.
to file my
right, it's a pain in the butt.
return.
It's going to cost me money to do it, but I know I won't owe money, so I'm not incurring any kind of cost. But especially for people who have fairly modest incomes, there are different benefits that you will receive based on your tax information. So common examples would be in Ontario, we have the Ontario Trillium benefit, gets paid monthly. There's the GST HST credit that gets paid every 3 months. And a big one for a lot of our clientele is it's now called the Canada Child Benefit, formerly the Canada Child Tax Benefit. So the government will not determine your eligibility or the amount until you have your tax information filed. So even if you don't owe money, you want to get that information to them so that maybe they will give you other money back.
So I could have 5 kids. If I don't file my taxes, I'm not getting my child tax credits or anything.
Yeah, if once they use the past year's information, it starts the new payments in July. And then if they don't have your information after a couple months, they just cut it off until you show them the result.
Yeah, and I remember meeting with a guy who was pretty sure he owed a lot of money because he'd been self-employed in the past. He'd always owed taxes. And Revenue Canada was sending him these letters saying, well, you haven't filed your taxes, but we're assessing you.
Right.
We're guessing that you probably owe the same as you owed in previous years.
Right.
So because you owed $20,000 in the previous years, for the last 3 years that you haven't filed your taxes, we're assessing you for the same $20,000 times 3 years, plus the penalties, plus the interest. He owed a huge amount of money. And I said to him, well, okay, are these numbers right? And he said, I don't know. I'm not an accountant. I have no idea. And I said, well, file your taxes.
Right, exactly.
Let's find out.
Exactly.
And it turned out that he was self-employed for another year, lost money, didn't have any income at all, and then he became an employee for a couple of years. Yeah. Taxes were being taken off. So when he filed his taxes, instead of owing this huge amount of money, he actually got a small refund back.
Yeah, no, I know exactly what you're referring to. I can think of lots of, well, maybe not lots of examples, but enough examples of people who are, if the taxman is kind of lying in the background, they're all quiet, and then all of a sudden they wake up and they're sending you these notices saying you owe $50,000, $60,000. I mean, I can think of live examples where the person gets a taxes filed and they owe literally nothing.
Yep.
Right? They're thinking they need to come see us and file bankruptcy, and turns out they owe literally nothing, and then they start getting money back from the government. So, I mean, that's again, not too common, but that's a great way to help people.
And if you've got kids and they hadn't given you your child-related benefits for a year or two, there could be a big catch-up. So
yeah, for sure.
Get your taxes done. And I realize once you file your taxes, if you do owe money, then Revenue Canada is going to be pursuing you for it. But at least they're pursuing you for something you actually owe rather than something you fear that they might owe. So, okay, back to the tips now. So tip number 3. That's right. We went on a tangent. So let's pick up the pace here. Give our listeners lots of practical advice here. So tip number 3, most employees get a tax refund every year. So what's your advice for an employed person who's in the opposite situation and somehow is owing taxes every year? What should be going through their minds?
Right, and I guess in a way we kind of addressed that a little while ago. And fundamentally, you want to look at it and understand, well, why is it that I owe this tax every year? So the two kind of scenarios we talked about a few minutes ago was maybe I'm working a second job without enough tax coming off. Maybe I pulled money out of an RRSP and there wasn't enough tax coming off. So I mean, that would be the first step. Assess why is it that I owe taxes every year? And even though it might be fairly second nature for you and I with our background, sometimes people, it's too much. So maybe it makes sense to speak whether, if you have a tax preparer, usually they should be able to break that down for you to be able to give you advice. But if it's one of those reasons like that, ultimately it's making sure that from a second job, for example, that you talk to the employer and you voluntarily have extra tax taken off. Because again, like we said before, sometimes it's really difficult if money is tight to voluntarily have an extra, $50, $100 coming off each month. But you're either going to pay for it now or you're going to pay for it later.
With interest. So Yeah, and you gave two examples there. One was a one-time thing. Okay, I cashed out the rest of my RSP. Well, I'm not going to have that same issue next year, so I don't have to be having extra tax taken off next year.
Right, exactly.
But if I have two jobs and I'm going to continue having two jobs, then yes, making a plan to have extra taken off so that you don't end up owing.
Right. You identify that as a recurring risk and you take steps to stop that from happening every single year.
And don't let it happen again. Okay, so tip number 4, income taxes, and you already mentioned this, for most people are due April 30th. So I want you to explain the difference between when a self-employed person file their taxes and when everyone else does, and what's your advice to ensure they don't end up with a big tax bill when they file?
Right, and I think I was making the distinction earlier about the difference between a return and a refund. I mean, with a lot of people who use those words interchangeably where they don't mean the same thing. So remember, the tax return is the document saying, here's my income information from last year, where from that you calculate whether you have a refund or a balance owing. So for a self-employed person, they're allowed to file their return, again, the information, by June 15th. So that's later than the normal deadline that you and I would have as employees for April 30th. The catch is, if there's an amount owing on that return, the amount was still due by April 30th. So a lot of times people fall into the trap to say, they just think, oh, okay, I can file my taxes on June 15th. They don't realize that they had to pay the bill by the April 30th. And again, if we're seeing people who are self-employed, that means that there's some issues that have been going on where they haven't been making voluntary payments. They call them installments. If somebody hasn't been making voluntary payments throughout the year, then that's a situation where most likely they will be owing money that had to be paid by April 30th, even if the return could be filed later.
So that's a key point. There's two different dates. The taxes for everybody, though, are due April 30th. It doesn't matter who you are. So tip number 5 then, related to that, should you use a tax professional to do your taxes, or should you just do them yourself?
Yeah, and I guess my answer to that is maybe. It depends, right? I mean, for somebody who is self-employed, who works really hard, probably works really long hours, and is probably really good at his or her particular trade, but the bookkeeping, the tax return, stuff like that, maybe it's not their forte, or maybe they just don't have the time, just from a practical sense, maybe they don't have the time to invest to be competent enough at that. If that's the case, it makes a ton of sense to have a bookkeeper helping you either monthly or every 3 months with preparing things like your HST returns, your payroll returns if you have employees, and then also assisting you with your end-of-year tax returns. And again, it's a challenge if money's tight. Sometimes it's difficult to voluntarily pay somebody else for something when you say you can do it yourself. But I think you need to really have a reasonable assessment of the circumstances. Say, well, if I haven't been able to do this for the last 3 years, 5 years, 10 years, what is going to be different for this year? Am I going to be able to get over that hump and do these things on myself? Or does it make sense to spend a few $100 to have somebody assist me with this?
Yeah, I mean, we can all change the oil in our car ourselves, but is it worth it? Well, maybe yes, maybe no. Evaluate your own individual circumstances and see.
And even for an individual who, as an accountant, as a tax professional, as the kind of background I have, I would never pay somebody to do my taxes because they're not that complicated and I don't feel overwhelmed by it. But for a lot of people, even when it's a straightforward return, they feel so overwhelmed when they hear income taxes and they see they see the tax return and all these line numbers and just can get very, very overwhelming. So this is where, going to lots of different, high volume tax preparation companies, I think it's a pretty good business for those places. We're not going to name names, but even like a fairly simple tax return, if you go to a big company, is easily $60, $70, $80 or more, where maybe there's a benefit to going to a place like that for 1 or 2 years to make sure that the return is proper, that you're claiming all the normal things that you're entitled to. But if that's the case, if you're paying something like that, like every single year for a tax preparer to literally punch in a couple slips to a tax program, there's inexpensive tax software. There's software that is free of charge that can really walk you through how to do things simply. So I get it that it can be overwhelming, but maybe investing a couple years cost and then understanding it enough so you don't have to pay that money every year. That's probably a good balance.
Yeah, if your situation is the same every year, you can probably figure it out. If there's been changes, then
excellent.
Maybe it does.
If there's a change, then it makes sense to have a professional confirm, okay, how does this change factor into my taxes this year?
Have someone who knows what they're doing. So, okay, so tip number 6, I want to lower the taxes I pay and, I want to get a refund. So what's the most common way to do that? How can I pay less taxes.
Right. So the simple, we've referred to this already in different ways, an RRSP. So it's a registered retirement savings plan. And the benefit of doing that, when you put money into an RRSP, you get a deduction. So what that means is if I put $5,000 into this kind of investment, I don't have to pay tax on $5,000 of my income. So it really, when you calculate at the end of the year and doing your return how much tax you have to pay for the year, it can significantly lower it. And this is one of the examples of how the federal government, they'll have different programs worked into the federal tax system or other systems to effectively provide inducements trying to encourage certain kinds of behaviors. So whether it's Mr. Trudeau or a future administration, they'd much rather have us, if possible, take money now and save it for the future so that down the road people aren't struggling, people aren't as reliant on different social services. So trying to think ahead. So they're trying to motivate us to think ahead.
Right. So whether an RSP makes sense or not, of course, depends on your situation, what your tax rate is. If you've got other debts, maybe the money should be going towards that. But again, it's something to think about. And again, it's based on your own personal situation. So, okay, we talked about paying down debt. Let's go to the last three tips. And since this is Debt-Free in 30, let's talk about debt. So I want to make the last three tips ways to deal with Revenue Canada debt, CRA debt. So tip number 8, what's the first option to consider if you find yourself owing money to CRA?
Well, and I'd say that just whether it's Canada Revenue or any debt, the goal should be to try to pay it in full. And that means looking at your expenses. Is there a way to reduce expenses? Is there some way to utilize your other assets? Maybe you're a homeowner where you can borrow against the equity that you've built up. It can be challenging though, because with the government, because they're not on you every month or even every year, the challenge there is that amount that they're looking for, like once they wake up, the amount that they're looking for, sometimes it's just simply too much to be able to work out through a monthly payment plan, or maybe even if you do have a house, maybe the amount with all the interest and penalties far exceeds the equity that you've built up over the similar time frame. So ideally, you're able to work it out. People, you remember this. I mean, you get feedback from people all the time when they're trying to speak with CRA collectors. Like any large organization, it can be really inconsistent in terms of the treatment that people receive. Sometimes people encounter collectors who are very reasonable and take a bit of a sympathetic ear to a tough situation. And other times, simply not. Other times, it's very much, we need the money by this time or else. So that's can be the challenge. Like if it grows over 3 or 4 years, and then all of a sudden you've got the bloodhounds on you, are you going to be able to come up with $50,000-$60,000 in a couple months to get them off your back?
Well, and they've got the power, obviously, to do things like freeze bank accounts, put a lien on your house, and garnish your wages. So if you're at the point where that's happening, then that's clearly not something you can just discuss with them and try to work it out. So, okay, so tip number 9 then. The average person on the street assumes that even if you go bankrupt, that doesn't eliminate your tax debt. Now, I know that's not true. Explain how a bankruptcy can deal with tax debt.
Yeah, in the vast majority of situations, a tax debt is treated like any other debt, like a credit card, a line of credit, a payday loan.
So it's pretty simple. Right,
in most situations. So typically, like those debts are what we call unsecured debts, where they don't have any kind of lien registered against an asset. So a form of a secured debt would be something like a mortgage or a car loan, where a bankruptcy does not remove that lien from the related asset. So you said this a moment ago, that one of the powers that the Canada Revenue Agency has, if the tax debts kind of fester for too long and they don't get dealt with, if you're a homeowner, they have the power without your consent to register a lien against your home. So if things are getting to that point where there's negotiation going on, there's threats, they've already frozen your bank account, it's not very hard for them to figure out through the resources they have available that you have property in your name. So without your consent, they could register a lien against your property. And then if you subsequently go bankrupt, well, it doesn't automatically remove that lien. So the idea fundamentally is I go bankrupt, I complete my bankruptcy, I'm discharged from bankruptcy, it releases me from my unsecured debts. But if the government proceeded to get that lien before you did the bankruptcy, they're not unsecured anymore. They're secured against your property, and the bankruptcy does not automatically remove that secured debt.
Yeah, so it's not something you want to leave until they get to that point. But the key point, Dad, is taxes are included in a bankruptcy just like other debts. There are some special rules that may kick in very unusual cases, but obviously you can give our office a call. And
that's where when we're talking with people, we
that.
want to make sure we understand the details, make sure if some of those rare situations do apply, we address that before we jump the gun
Which
on
is what we do with every debt. I mean, there's special rules that apply for student loans and things like that too. So that's simple enough. So tip number 10, final tip of the day. So if I can't make a deal with Revenue Canada because I owe too much and I don't want to go bankrupt, maybe because, as you described, I own a house or something that has some equity in it, and I don't want to just do nothing because I'm afraid they can garnish my wages or put a lien on my house, then, tip number 10, what's another option that deals with tax debt? And I'm setting you up here because I already know the answer to this.
Right, yes, I see where you're going with this, yes.
But what's another option that deals with tax debt but doesn't have the downsides and the risks of all the other options?
Right. So what you're referring to is a consumer
That's
proposal.
Exactly right.
Yes,
a consumer
thank
proposal
you. You kind of lobbed that up there right for me, Doug.
Nice softball.
Yeah. So, but right there, that's where, again, for any kind of consultation I'm doing with somebody, it's really what we've described here, where the first part is, what is the situation? Is there a way for you to pay back the debts? And if the answer is no, then in most situations, it's not realistic to just ignore the debt. I mean, tax debts don't just go away. Credit card debts just don't go away. So then if the debts are too much, but you need to do something to protect what you still do have in terms of your assets and your wages, most times the conversation starts to focus on whether a bankruptcy or a consumer proposal would be the better option for you. So a consumer proposal, as you know, fundamentally is where we're acting as the administrator, the trustee, the licensed trustee is acting as the administrator of the proposal, and we're trying to effectively broker a fair deal between the two sides. We have the person who owes the tax debt. There is the Canada Revenue Agency who is owed the money. But a proposal can include tax debts. It can obviously include other debts like credit cards, lines of credit. So just like in bankruptcy, a consumer proposal can be an effective way to deal with the tax debts.
So in your experience, does Revenue Canada play ball in a consumer proposal? And you're exactly right. A consumer proposal is a deal. Everybody you owe money to they get a vote in the proposal.
Right.
And it's, again, we're oversimplifying because there are special types of proposals, but generally speaking, it's majority rules. So if you owe $100,000, if 50,001 vote in favor, then the proposal goes through. So if Revenue Canada, CRA, is the biggest creditor or one of the largest creditors, what are the chances that they're going to say yes to the proposal?
Well, in my experience, and you said I've worked here for about 8.5 years now, and I really feel like there's been a change in the climate, specifically with Canada Revenue Agency over that time. So there were some times where, fundamentally they take it on a case-by-case basis. So that's number one. I mean, we've seen from a lot of the big banks, they're just very structured, very regimented. You need to hit their targets in terms of how much money they want back. Canada Revenue Agency is very case by case. So I don't discourage people from doing a proposal if it's taxes, but we need to be prepared for a few more questions than if it was straightforward bank debt. So they usually want to have, it's usually not face to face anymore, but usually there's at least a couple calls, like either meeting in person or a phone call to review the details of the proposal. And if they're satisfied that it's providing them a fair rate of return, they're satisfied that it's providing a better rate of return compared to if the person did a bankruptcy, which is fundamentally what a proposal is about, right?
Yep.
And they're satisfied that you can afford the payments that you're offering, and that you'll be a good tax citizen going forward, that you're not at risk of having recurring tax debts. It's been a long time since I had a real issue with getting the Canada Revenue Agency on board with a consumer proposal.
So if it makes sense, then there's a very good chance we can get them to agree to it. So, well, excellent. Thanks, Ian. That's a great way to end it. You gave us 10 great tips. So what's your final piece of advice then before we close the show?
Well, I think it's basically don't ignore it. I mean, if you're to the point where you know that there is a tax issue going on, don't just ignore it. I mean, the challenge we talked about before is that taxes can kind of grow kind of in the background, silently, quietly. But once they wake up, once the collectors are coming after you, sometimes it can be too late to try to work it out on your own. So if possible, try to be proactive. But if you are to the point where you feel like it is too late, I mean, certainly me, you, our colleagues, this is what we're trained to do, right? We try to just sort through the situation and find the right answer for that particular person in front of us. Absolutely.
Yeah, it's kind of like the elephant. It's sleeping for a while, but then when it wakes up, it tramples everything in its path.
I prefer hibernating bear.
Hibernating bear.
Hibernating bear.
Yeah. That's a better way to put it. But yeah, you're right. Tax debts and most other debts aren't just going to go away on their own. And certainly with tax debts, there is no statute of limitations that makes them go away. So it's something you got to deal with. So Ian, great. Thanks very much. That's great advice. Thanks for being here.
Oh, thank you, Doug.
You can find more about how to deal with tax debts on our website at hoys.com. Ian and the entire Hoys Michaelis team, of course, offer no-charge consultations. So if you have tax debt or any other kind of debt, by all means, give us a call. That's our show for today. Full show notes, including a full transcript and links to everything we discussed today, can be found on our website at hoys.com. That's HOYES.com. Thanks for listening. And if you know anyone who has tax debts, please share a link to this show with them. Until next week, I'm Doug Hoys. That was Debt Free in 30.